right, hello everyone. Hello, and hello. Welcome to the Financial Literacy Program with WeSERVE CDC has partnered with Will Way CEC to bring financial literacy to our WeSERVE Cares program. The Financial Literacy Program will be held on the second Saturday of every month at 10 a.m. Today, we're going to be discussing on home buyers benefits and financing options. And this is how we do it. We talk about financial literacy. And this specific session, we're going to be covering first home owner benefits. And it's brought to you by Will Way CEC and WeServe program. And so meet your facilitator. For those who are familiar with me and those who may not be familiar with me, here I am. This is who I am. I am yours truly, Renix Graham, the financial literacy facilitator. I am a business entrepreneur. I am the senior field manager in the financial service industry. I have 8 years of experience, going on 9 years as a financial strategist. I am multi-state licensed in certain regions of our country, serving in the healthcare insurance industry, the life insurance industry, and the retirement account industry, covering IRAs, 403Bs, 457Bs, and so forth. And so today's agenda, we will be covering the benefits of home ownership. That's number one. Number two, we'll be talking about financing options and down payment assistance. And lastly, number three, we'll be covering accessing retirement savings. And so today I have some help today. I'm very excited to have Miss Deanne Graham. She is a veteran in the mortgage industry with 15 years of experience. She has wonderful, great tools and nuggets that she will be providing on today. And I'm going to get out of the way. And Mrs. Graham, you have the floor. It is now in your hands.
Thank you, Mr. Graham, so much. Welcome everyone to the Home Buyers Benefit and Financing Options program with WeServe and Will Way CEC. Today, I'm going to be covering bullet points number 1 and 2, benefits of homeownership, as well as financing options and down payment assistance. If you're a first-time home buyer, this is going to be a very good program slideshow just to share with you the opportunities that you have available. So let's go ahead and get started. With benefits of home buying, we live in the United States of America, and we all, many of us, talk about the home owner's dream, right? The dream of owning a home. And so there are opportunities out there to help you get there. And there are benefits that come with home ownership. The first benefit is the basic is happiness. The feeling of owning your home is unmatched. You can fix it up, make it your own. You can get a pet without having pet rent. Some of you guys know about that. Plant a tree if you like. And that's something that is the ownership part of not having to have someone over your head or beneath you, giving you directions or telling you what you can or cannot do. So there's a lot of liberty there. The other benefit is the tax savings portion, very big. The government rewards homeowners by providing excellent tax benefits. The interest that you pay on your mortgage and other home-related expenses can generally be deducted from your income. And that even includes like getting a solar roof or even like solar windows. They give you the opportunity to save when you get these things that's going to keep you in your home and keep your home protected for you and your family. So they support that. The appreciation portion. Home values have a well-documented history of going up over time. This increase becomes equity that you could benefit from when you refinance or sell. You may have heard of a home equity line of credit. That is a result of the appreciation value. We'll get into that in the future when we talk about after you become homeowners. And then going back to the equity again, renting has often been compared to paying 100% interest, means that you don't get any return on your rent. You're paying to stay. However, when you own a home and a mortgage is in place, you have a portion of your rent, which we call your mortgage, that goes towards the principal balance of your loan, which is the cost of your home many times. And then that amount will increase over the time and it becomes equity. This builds your equity and act as a savings account. I talked about the home equity line of credit that you can borrow from, that you can withdraw from, or even refinance to get a larger home or a home that costs more money, or to rebuild. Maybe you want to build a wheelchair ramp, or you wanted to add on a nursery or put a pool in the back or something like that. Your equity will give you the opportunity to do that without money out of your pocket up front. The next is roots. People who own rather than renting stay in their home 4 times longer. Many of us have grandparents that have lived in their home. They raised their children in their home, and now we have children, and our grandparents are still in that home, right? 40 plus, 50 plus years. You get roots, and you create that family dynamic of home ownership that then your children and your children's children can have a part of. So that's another benefit of home buying. And then education. Research shows children of homeowners earn higher test scores and graduate at a higher percentage than those versus renting. And I would think this is a result of renters sometimes move around often. Even let's just say military, they're considered renters, many of them that don't own homes, and they go from state to state oftentimes, and they don't have the roots there, and then that could shake up the educational portion. So I could see how that could be a benefit of home ownership. Let's get into the number 2, which is talking about the types of loans. The first is the most recognized, which is the conventional loan option. It's named conventional loan because it's not government backed, which means that the bank or the broker, wherever you go to get a loan for your home, it's not necessarily going to be backed by the government. We'll talk about the government-backed loans shortly after this. Typically, it requires a 20% down payment to avoid PMI. Okay, PMI is private mortgage insurance, and that is just a protection clause. It's almost like it's an insurance, right? Like your vehicle have auto insurance. It's to protect the lender who gave you that money for the car. Should your car get hit or totaled out, the lender's like, hey, I gave you $25,000 to pay off that car, and you're thinking like, well, I don't have the car, so I don't want to pay. Well, what they do is this is a coverage for the lender. PMI allows the lender to have a protection. You're putting money into this account if you don't put down 20%. Now, as it says here, a lower payment loan is available from 3 to 5%. That's typically for people who have really great credit scores, and they don't necessarily require that 20%. But if you do get a lower payment loan with the 3 to 5% down, chances are that you do not have the PMI, right? Because you actually have the money to put down. Okay. The next piece is PMI can be dropped once the 20% equity is reached. So if you don't have 20% to put down up front, no problem. As you're paying your mortgage every month, you're also paying into that PMI insurance. However, your mortgage principal balance is going down, and then your value, we just talked about the equity, is going up. And so long as there is a 20% pay down between the loan value and the cost or the value of your home, it will eliminate the PMI. Okay, so that's huge. People rush to get to that after a few years paying that down, they can apply to have that removed. Now, your credit score do need to be 620 or higher for a conventional loan. And then jumbo loans, which is loans over 424,000, require a credit score of 720, okay, and above. So conventional loans is really, it's open to all. There's a lot of opportunities out there. But if you are on the lower end, meaning that your credit score is not above the 720, if you don't have the 20% to put down, we always recommend the FHA loan. The FHA loan option is typically the first option for first-time home buyers. This is a loan that's backed by the Federal Housing Agency, which is very good. It's a government-backed loan, and this is geared towards, again, those with low credit scores, and then you don't have a lot of money to put down. Mr. Graham will come back later and talk about if you don't have the cash up front, how if you've been saving for retirement, how you can utilize those funds for that. But more about the FHA loan options. You could put down as little as 3.5%. Okay, that is required for you to be approved with this. Okay, and then the credit score needs to be over 500. I think that that's amazing. A lot of people, I remember back in the early 2000s, like you couldn't even get a home if you didn't have 640, like you had to be a higher credit and things of that nature. But now the industry understands that everybody doesn't have it like that. And sometimes a 600 or a 570 credit score doesn't necessarily mean a poor payment return. It doesn't mean that you have delinquencies and repos and things of that nature. It could just be your debt to income ratio that drops your credit low as well. So they understand these things and they've expanded it. So now you only need a 500 credit score, and then 580 credit score gets the 3.5% down. Scores between 500 and 79 has a 10% down payment. Okay. So again, 10% is still less than that 20% for the conventional loan, since that 500 score probably wouldn't allow for that conventional loan to be approved. So FHA is definitely a way to go for first timers. Now, mortgage insurance, which is the PMI, is required on these loans regardless of the down payment amount, unfortunately. Possibly for the life of the loan. I've seen that where you got your property down, your value of your home is higher and your principal is lower. And so there's that 20%. Okay. Unfortunately, sometimes it depends on if there's a certain box clicked on your HUD agreement or your contract. You can have that PMI removed, but sometimes you have to have it for the life of the loan. And if you got that value down and you got the value up, excuse me, and your principal, what you owe is less, you can always refinance, especially if you've been working on your credit and improving your score. Go back and refinance to a conventional loan, right? And then you could get rid of that PMI. You don't necessarily need any money down or anything because you already have the house. You're just doing a refinance. Okay. So that's the one benefit of coming in early, pay that PMI. Yes, it's an extra fee that you're paying every month, a certain percentage. However, you want to get your foot in the door because of the equity value that you can grow, and all the benefits that we talk about of home ownership, and then you can refinance to conventional later. Generally, yes, FHA over time is more expensive than the conventional loans, and that's okay, especially for those who are first timers or who have a lower credit score and they just wanted to get a piece of the American pie. Okay. So the next option that is available that is also government backed is VA loan. Now, with the VA loan, again, it's backed by the Department of Veteran Affairs. So this is for military personnel. You could be currently serving in the military. You could be an eligible veteran. Okay, sometimes if you were dishonorably discharged, may not have those benefits available to you, or even surviving spouses of veterans can take advantage of the VA loan. So definitely a benefit here. Let's talk more about what you get with this. 0% down. Amazing. So you don't have to have any money, right? If you're currently in military, if you're eligible veteran, meaning that you're no longer serving, you're not active duty, but you're a veteran, or if you are a spouse of a veteran, you have the opportunity to get a VA loan with zero money down. Now, the government doesn't set a minimum credit score, which is also another huge benefit, but some lenders do want you to have at least a 620 or better. Okay. So if you don't have a 620 or better, you are a veteran, or you're approved for a VA loan, and your lender, that particular lender, does not want you, does not allow under a 620 score or better, just go to another lender. There's more. My mother-in-law said there's plenty of ways to skin a cat. There's more ways to get what you're trying to get. Okay, so that's a big benefit here. No major credit score requirement. Also, too, no mortgage insurance, no PMI, regardless of the down payment amount. Okay, but a related fee may be assessed at closing, and that's depending on your lender and your broker. Okay, so you got to pay attention to that. If you have a really good agent, they can walk you through these things as well. Good credit and a good size down payment. If you have good credit and a good size down payment, you may want to go conventional mortgage route. Okay, because it may be cheaper for you in the end because you have the credit score that can get you to that place. Especially if you have a large down payment. I was working with a veteran, a retired Navy man that had sold his home. He had a large, $200,000 down payment. He didn't necessarily need to take advantage of the VA option because he qualified for a quality loan that had a better interest rate on a conventional side versus VA. So sometimes it's great to have the benefit, right? And it's also great to have options. So can, if you can do conventional, always going to be the best option. But for those who have served our country, thank you for your service. You have some other options that many others don't. Okay. So that's the lowdown and the down low on the VA loans. Now let's talk about the USDA loans. A lot of people, this is kind of coming out. I'm seeing more about this in the last 2 years. We like to call these the rural development loans. These loans are backed by the U.S. Department of Agriculture. It requires you to move out, right? To move out of the city. If you find some land that is not in, the heavily populated city area, you absolutely can be approved. They have certain criteria, right, for the area that you're going in, but you could build a brand new house, okay, with the USDA loan, okay? Now let's talk about the other benefits of it. It's intended for low to middle class income earners looking to buy a home in the rural area, not the city time, okay? Zero down payment, okay? We're talking about a new build, no money down, don't have to be a VA, right? That's the other one that has no money down. The USDA loans, if you're approved, you can also go with no money down as well. Now, a credit score of 640 is required, okay? And then mortgage insurance is required for the life of the loan, which is okay. And then it also have a related fee at closing. This USDA loan is typically cheaper than the FHA loan off the top because remember, you don't have to have any money down at all. And you could get a new build, whereas sometimes with FHAs, there's just certain requirements around. So I'm going to say you got excellent credit. You definitely want to get a conventional loan. I want to say if you are a first-time home buyer, I would definitely caution you to consider the FHA loan. Okay. And if you're okay with not necessarily living in the city, definitely want you to consider looking into the USDA loan option because it's not often tapped into, and there's a lot of benefits there. And if you're a veteran and you don't have the money, that you're not currently a homeowner, or you don't have a big money piece, I definitely would recommend that you utilize that opportunity that you have because it's specifically only for veterans. Okay, so those are the 4 different type of loans. Let's talk about those who need help with down payment assistance. Yes, that deposit, that 3%, that 20%, whatever that is, there are down payment assistance programs available for you. Now, I'm going to talk about the state of Texas and Virginia because Texas is where Will Way Community Enrichment Corporation is headquarters in, and then Virginia is where WeSERVE and the WeCARES program is headed in. So let's first go into Texas down payment homeowners assistance. So it's called the Texas State Affordable Housing Corporation, and it offers funding for down payment and closing costs. We didn't get into that part. Sometimes there are some fees that you're going to have to pay, loan origination fees, closing fees, taxes for the time that when the previous homeowner stopped paying to where you start. They just get things all in order for that. So just keep in mind that's another funding piece that's needed, and that's where the down payment can help. And it's in a form of a grant, which is free money. We call it OPM, other people's money, or a deferred forgivable second lien. Deferred means that you may have to pay it back over time, but it's forgivable if you meet certain criteria. Okay. The grant does not need to be repaid And the second lien, called a forgivable second lien down payment assistance, is fully forgiven so long as the homeowner does not sell or refinance within the first 3 years. Keyword. So imagine you taking advantage of a home, purchasing a home, and in 3 years you decide to do it all over again. And all you have to do is live in a home for the first 3 years, and you don't have to pay it back. If you decide to sell, move out of the country, refinance to get a lower interest rate or something like that within the first 3 years, that second lien down payment assistance, which is a second lien, is going to have to be paid. Okay, so you got to work the system. Okay, the second lien has 0% interest. We love that, with no monthly payments. It will cover up to 5% of the total purchase price. Now, keep in mind, no monthly payments if you don't sell or refinance the home within the first 3 years. It's a key piece. Borrowers can use this program in conjunction with the FHA, the VA, and the USDA, and even conventional loans. All right. Now, in order to be eligible for this, is specifically for the state of Texas, you need a minimum score of 620. And what I love the most, which is why I say, honey, you can rinse and repeat and build your portfolio. You don't have to be a first-time home buyer. So this is huge. And I just, again, want to advise you that every state has some type of down payment assistance program, okay? And even some certain times you could get in certain cities or counties that they have money, maybe you could double up on that down payment assistance. You know, we talk about working the system, you got to know what's available so you can take advantage. Let's go to Virginia, down payment assistance program. It's called the Virginia Department of Housing and Community Development. It's a VDHCD, okay? They have a down payment assistance program for first-time home buyers or those who have not owned their home in at least 3 years. There go that 3 years again. And it's called Home Ownership Down Payment and Closing Cost Assistance Program. Remember, we're going to always have some type of closing costs. We want other people, OPM, other people's money to pay for it. Borrowers can receive up to 10 or 15% of the sales price for the down payment, as well as $2,500 for closing costs. This is huge. The other one was a little less of the sales price. This one is a little bit more. Now, in order to be eligible for the state of Virginia down payment assistance, the borrower must not earn more than 80% of the median income. The homeowners must get counseling. So there's like a class that you take, and they give you a certification at the end confirming that you have taken this first-time homeowners or even just a homeowner certification class. Is an educational course that they have available through VHDA and NeighborWorks, okay? And then you must contribute. You have to have some little coin in there. 1% of the home sales price from your own funds, okay? Now, we can talk about that 1% with Mr. Graham, and I think he's going to be coming up next. So again, we talked about the 4 areas of funding options, and then now I'm going to go turn it over into the hands of Mr. Graham, because we could talk about how you can get that money that you have from your retirement. It's in your hands, Mr. Graham.
Excellent, excellent, excellent. Such great tools, wonderful nuggets that has been shared on today. And I tell you, there is many options. There are just a wide array of options in terms to how to get access to your loans. And it's not just one way. As my mother would say, there are more ways to skin a cat. And so I'm very happy to even broaden and open up that door even much wider by just showing you how to access your qualified retirement account. Those who have retirement accounts, you can also get access to that as well to, get funds out, perhaps if you run out of options. And so 2 ways on how to get access to your retirement. We have the withdrawal option and we have the loan option. We want to start with the withdrawal options here. All right. We have this called qualifying events. Typically, the IRS would want to find any type of way in terms to proof, such as your invoices or any proof in terms to your qualifying events. So some of the bullet points I'm going to talk about is you have a funeral expense. God forbid something happens, a loss of a loved one, a son or daughter, someone who you know. if you have some type of invoice to show proof to your company, your 401k company, your 403b company, your IRA company, then they will be able to provide that loan to you or that withdrawal. And it's called an emergency access waiver. All right. School tuition, if it's to pay your child for college or niece or nephew for college, if you have a receipt, some type of proof of something within the next 90 days or the previous 90 days of showing receipt of the college payment, they can be able to also qualify you for that withdrawal as well. Medical expenses here in this country, the debt regarding medical is sky high. It's one of the highest, and if not number one, right? And it takes money to be able to take care of medical expenses, surgeries or medicines or anything like that that needs to be taken care of on an emergency case matter. You have proof to be able to provide that to your retirement company. Also, prevention of eviction or foreclosure for those who are trying to stay in your home or to stay in your apartment, wherever you may reside, right? As long as you have proof to show that I live here and I'm trying to do what I can to pay my mortgage or to pay my rent, your company should be able to provide that way for you. You have natural disasters, things that are out of your control. If it's your property has been destroyed or a tornado or lightning strike or whichever, the ground split up, whichever the case may be, you have proof to show that this was a natural disaster. That will also be a qualifying event. Also for purchase or repair of principal residence. Principal residence, we're talking about home here, right? To repair your home, your principal residence, even a business place. If you have some place of business, commercial property, if you own that as well, as long as you have some form of proof, some form of invoice or receipt, then that will also qualify you as well for that event. We also have, with that withdrawal, we have 20% tax withholdings on pre-tax accounts. Now, 20% tax withholdings are applied whenever you're taking withdrawals out of your account. That typically happens. There's no way around it. We end up having to pay taxes, but the good news is that you're able to get access to getting that withdrawal whenever you need that as well. And then we also have the 10% early withdrawal penalty if you are below 59 and a half years of age. If you're withdrawing money out before 59 and a half years old, and if that account that you have, such as a 403b, 401k, IRA, Roth IRA, those are qualified events, qualified codes, then you are eligible to pay if you're withdrawing earlier than 59 and a half. All right, so that's the withdrawal option. We're moving right on to the loan option. All right, the IRS qualified accounts, that's pre-tax and post-tax qualified plans. You have your 401k, then you have the Roth 401k, you have the 403b, then you have the Roth 403b. You have the 457b, you have also the Roth 457b, you have the IRA and the Roth IRA. And now, let me just backtrack real quick. You have the 401k and you have the Roth. So you hear such as the 401k and you have the Roth. Well, what's the difference between the two? Well, I'm so glad you asked. So the difference between a 401k and a Roth 401k, and this goes for all of the following tax codes underneath, is that the 401k is a pre-tax plan, which means that when you're making monthly contributions into your 401k, you're not being taxed on contributions. You're not being taxed even on growth of your 401k account. You're only taxed at the time you're ready to start receiving income. So if you're getting recurring income on a monthly basis, or if you're making that an emergency withdrawal, any type of withdrawal, you're going to be paying taxes because you have not paid taxes on contribution, but you pay taxes later on, which is considered tax deferred. That's the 401k portion there. The Roth 401k says that your contribution typically are being contributed, say, from your bank. So you may have a bank account. Okay, all funds that are within bank accounts are post-tax funds, which means they've already paid the taxes. The taxes has already been paid and is knocked out, right? So you're making your contributions with post-tax money going into the Roth 401k account over the stint of, say, 26 years, 30 years in your career. Now it's time to take funds out as a withdrawal, as income. You're not having to pay taxes. That income coming in is income tax free for the Roth. So that's the way that works for post-tax qualified plan. That applies for the 403B pre-tax as well as the Roth 403B, 457B, Roth 457B. Now for the IRA and the Roth IRA, the same applies to those two as well. The only significant difference between the IRA and the Roth IRA, they both are under the rules of being excluded from loan options. You're unable to take any loans out. However, if there was an emergency and you need to get the emergency access, right, in case if it's a qualifying event, like we were talking about in the withdrawal options, you're eligible to get that perhaps if you do have a qualifying event for the IRA and the Roth IRA. And so typically one can borrow the lesser of the 50K or 50% of your account balance. So you're eligible to borrow of that 50% of the account that you do have there. All right. Repayment for home purchases are up to 30 years versus the traditional loan repayment of 5 years. So that repayment for the home purchases is up to 30 years, right? Versus the traditional loan repayment of 5 years. So there's a difference between that time frame there. All right. Lastly, the copy of your contract will be required to take advantage of the loan and withdrawal options available. So it works on both ends of the spectrum. Okay, so the company, say that you have, let's say, for example, National Life Group or with Equivest, right? And you say, hey, I'm in need of $15,000. Okay, they would need an invoice showing proof of that. Right now, the other, let's say the company that you may need to say the big pipe busted, God forbid it happens underneath your home, right? And it's flooding out your backyard. Okay. The company, the plumbing company may say, okay, well, show us proof that you have an account with National Life Group or with Equivest. So the fact that you are enrolled with this retirement account, you can always go back to them. You can talk to your provider, whoever is your representative, and you say, hey, here's my policy number. I just need an invoice showing that I have an account with you all and I am enrolled with you all as well. So you have proof on both ends. You have qualifying event proof, and also you have your enrollment profile with your retirement company as well. And so that's how that works. That's how you gain access to the qualified retirement account. All right. So briefly, let's just recap on what we have discussed on today. Mrs. Graham have talked about the benefits of home ownership. Once again, a plethora of good information that was discussed. We talked about the tax savings, the appreciation of value, the equity that is available to you. Also, the financing options. You have the conventional loans, the FHA loan, the VA, and the USDA that is available to you as well. Okay, we have the down payment assistance program for the 2 states of Virginia and also Texas, right? And then, of course, accessing qualified retirement savings by way of withdrawal, by way of borrow, and also qualified accounts as well. One thing I want to slip in here regarding your retirement account. Let's say, for example, if you needed a loan, that's just another option. If you needed that loan out of your account and you have $50,000, right? And you say, hey, I needed 50% of that $50,000, they will allow you to borrow that $25,000 from the company. And here's the good news, is that $50,000 that you have in your accumulated value is not subtracted to $25,000. You still get to keep the $50,000. That just shows that you're in good standings with your company. That means they like you. You've been faithful in your contributions over the years. So perhaps if you needed that loan, that's also available to you as well. And we'll definitely discuss more into that later on down the road. All right. Perhaps if any of you have any questions regarding getting access to your loans, getting way to finance for your homes, feel free to contact us. I am Renix Graham, the facilitator, and you have my email that's provided here, r.graham@willwaycec.org. And also you can schedule an appointment with us with the calendly.com/RenixG03. And also you can surf the site. Come visit us at Will and Way CEC website. That is Will and Way, I'm sorry, www.willandway.cec.org. And we'll be glad to have you there as well. Also, we want to hear feedback from you. Feel free to take a survey, leave us your feedback. Once again, we love to hear from you, and that's how we roll. And that's what we have on today. I want to openly thank Mr. McCowan of WeCARE's program. Thank you for having us for this financial literacy program. And other than that, we will see you soon. Ms. Graham, thank you for joining us on today. All right, y'all have a fantastic day. Take care.